I believe today Peter will be going over the on the topic of refinances and UWM. He will be going over a type of refinance conventional that through Fannie and Freddie that I have never done. So we'll turn this over to Peter.
Good morning, everyone. Thank you, Wagner, for the intro. Today, we're going to deep dive about the conventional Fannie Freddie Mac's refinance product that goes up to the 50% debt to income ratio. And this will align to the vision that we have as a loan officer running DU findings as well. So I'll take any questions I'll take any questions after the training is done, okay? So here's why it matters to know about this refinance product. You've got a borrower sitting in your database right now who refinanced back in 2022 or 2023 when the rates were in 6, 7, and 8. And they think they're stuck because of the multiple credit cards or car payments or student loans. And assume that their credit isn't good enough or debt is too high so they can't afford the closing cost. You can show them that they're wrong. After today's training, you'll be able to help them one by one exactly how to help them. And this is a working, proven pipeline strategy that we can put money back into your client's pocket and loans into your dashboard. Let's get into it. These are the agendas. After training is done, I'll share this slideshow in the team chat so that you can also learn from it. So what are these, right? RefiNow is a Fannie Mae's version. Refi Possible is a Freddie Mac's. They're practically identical twins. Same rules, same structure, same purpose. They're government-backed affordable programs designed to help low to moderate income homeowners. The kind of borrowers who you routinely get stuck out by traditional refinancing because of underwriting guidelines or the FICO scores are saying they're too risky. So Fannie Mae and Freddie Mac already owns and services these loans. So in their eyes, it's not a new risk. You just have to manage the risk, helping them from the high rate individuals to lower payment to reduce any harms that come into play. It stabilizes the borrower, financial standings, and the purpose keeps the loan performing in their book pipelines as well. So if you get into the details of it one by one, which program does this borrower use can come in. Answer is very simple. It depends on who currently owns their loan. If a Fannie Mae owns the loan, it goes into RefiNow. If the Freddie Mac owns it, then it goes into Refi Possible. There's no strategic choice here. Most homeowners have no idea who owns their mortgage. They only know the servicing company's name. So they send their payments to a servicer. It could be Wells Fargo, Rocket, or whomever. It doesn't matter. That company is just a processing payments. They almost never own the actual debt. Both Fannie and Freddie Mac have free lookup tools on their websites. So you just Google search Fannie Mae owned mortgage or Freddie Mac owned mortgage. And you plug in the property address and the last 4 digits of their social, and it tells you instantly. It takes about 30 seconds. This lookup is a mandatory first step every single time. So never skip it. Don't skip it. So let's talk about the qualification. The first major hurdle is the income eligibility. To qualify, the borrower's total income has to come to at or below 100% of the AMI, area median income, for their location. So this is a threshold that we have to memorize. Unlike the home ready, home possible product that goes into 80% AMI, we can look into 100% AMI for this. So when they don't qualify, period, you don't have to spend more time on it. So this is highly localized. AMIs in Orange County, Los Angeles, any high cost counties share the same data. But when it goes to Riverside, San Bernardino, current counties, AMI limit changes. So when you have multiple borrowers on the loan, let's say 2 spouses, for example, you have to aggregate their combined qualified income. You cannot just leave the higher income earner off the application to go into the system. The agencies are designed to prevent exactly the situation. One is to confirm the income is at or below 100% AMI. If not, stop right there. And thankfully, our income limit went up last year. So whatever that we had failed to assist can be helped again. At around June of this year, 2026 AMI update will come into play. But don't wait until then. If you have a client who passes this income limit back by 2025, utilize it. So now let's talk about the most aggressive part of this program, debt to income. Conventional loans usually have a debt to income cap at 50. But these programs can go up to 65. So when we talk about the perspective of a client, let's say who has $6,000 monthly income and has about $4,000 of monthly payment on a mortgage, and with the cars, credit cards, and when the debt to income is below 65, under conventional guidelines, you can send it to RefiNow and Refi Possible. So this is a flexibility that we can play for the high debt borrowers. So instead of sending this client to FHA to refi, we can do a refinance through conventional guideline. And this is a surprising part. Usually, the agencies ask for 620 or above for the qualification. When you run the DU, you'll understand that we don't need a minimum FICO score for this product. As long as we are able to run DU and have approved eligible status, we can qualify. Okay? Specific lenders, specific investors may have their own overlay. But the reasons why we use Loan Sifter is find out the prime product that sells to the servicing company, to Fannie Mae Direct, where we send directly to Fannie Mae. So depending on the pricing, depending on the qualifications, our final rate may be changed. But I want to emphasize that this is the only way to pre-qualify, to run the DU and find out about the eligibility. AUS has the final authority, okay? So this is the final draw line. Payment history is what they emphasize the most, just like FHA Streamline or VA IRRRLs. They're giving you all these flexibility and DTIs and credit scores, but they demand absolute proof on the mortgage statement and credit report to show 0 late payment in the last 12 months. And 6 months rules apply. When there was a 1 late payment or more in the last 6 months, we cannot even begin the process. So max rule within the 6 months is 0. Within 12 months is 1 time. Okay? And this COVID rule used to be there. It's no longer applied with us. And let's talk about the appraisal. So we all know conventional products have a PIW and ACE for Fannie and Freddie Mac. So traditional appraisals costing between $500 to maybe $900 depending on which market your subject property is at. This is a huge upfront barrier, the cost that they anxiously get to the homeowners that stops from applications. So this program solves in 2 different ways. First, we can rely on the AVM by running the AUS to find out about the PIW to waive the appraisal requirement. Second, if the appraisal report is required, the lender, Giving Tree in this case, receives a $500 credit. We can apply it directly to the borrower's closing cost. So like Ragnar said, because UWM is heavily relied on Fannie, Freddie Mac's decisions, we can also receive that benefit. They're not the best, but if the $500 was the critical reason why the borrower was not moving forward, we can send it to UWM and get it done. Point here is to get things done. This is a mandated, pre-fixated closing fee that is guaranteed by the GSEs. So the benefits we receive by doing this, so you can't just refinance right away, just like the regular full doc or refinance rate in term transactions. You have to consider these 2 additional things. One is that the rate must go down at least 50 basis points or 0.5%, and the monthly mortgage payment has to go down significantly. The key term here is a net tangible benefit. So for example, you may have a client who wants to roll in their $10,000 closing cost into their loan balance, unpaid principal balance. If so, even if the rate goes down, their monthly payment may not go down. Let's assume a principal balance at $150,000. especially in that case, this RefiNow, Refi Possible may not work if we are only cutting down 0.5. We have to bring it down more to qualify both options. Rate else to go down, and the PI payment must also go down. And the point here is actively going down. And what does it mean by Fannie Mae is the AUS will determine the closing cost and the monthly savings. So we, processors, loan originators, cannot and will not predetermine. We will run AUS, and only through AUS will determine yay or nay before we submit the file. So what we cannot do with this product, we cannot give them more than $250. The FHA Streamline has a hard stop at $500, right? So forget about the $2,000 or 1%, whichever one is higher rule. That doesn't apply with this product. This is not a limited cash out. Although it looks like it, think of it like a no cash out option. So what we need to do is to receive the fee worksheet, reverse calculate, or put everything line by line into a Calyx point, which is done by our processing team or submission desk. We go back into Calyx point, we submit the first payment due date and the estimated closing date, and calculate the specific closing cost and details and find out this. Payoff demand better be ordered in timely manner. Okay? So we cannot allow this portion to be omitted. So make sure you do this before you process the loans. Second, there's a property restrictions. Eligible properties are restricted. If the subject property is not converted into rentals, we cannot begin. Or second homes or ADUs or built a second unit behind, we cannot begin. And third, we cannot consolidate any debt into this loan. So you cannot pull equity like a kitchen remodel. Or if your client wants to cash out, this program is a wrong tool. We direct them to the regular conventional rate and term refi or fold out cash out refi. So, also the HELOCs. So when the borrower already has a second lien to the property, tied to the property, we may subordinate the lien, but we may not roll a second mortgage in and combine the payment. Combining the first and second payment will be considered a cash out. So remember, there is a subordination fee of 0.625 on every single refinance transactions. So keep that in mind when you quote the rate. So for us to calculate the break-even point, when client says, if I refi now, what benefits do I get? Let's hypothetically say the client is paying about $3,000 for the closing cost for the refi and saving about $100 a month. Divide the cost divided by the monthly payment savings will give us 30 months, 2.5 years to break even. So if your client is planning to sell or move within this 31st month or 30 months or below, then refinance is a bad move. They will pay more in loan cost than they recover in monthly savings. So don't destroy the relationship and wealth by doing this. If you build a habit of building this, we have a refinance calculator in our homepage. You can actively use that to compare or use this metrics to compare and tell them the reasons why they must apply. Even with the $500 appraisal credit, closing costs still exist, right? Title insurance, recording fees, origination charges, and these things add up. So run this calculation on every single file, document it, and this flexibility of 65% DTI or credit score leniency doesn't override the fundamental math of capital. So I strongly believe the data dictates decisions. We must make decisions based on data. So the clients, not on the emotional, not the emotion of getting the lower rate, right? Don't be one of these guys out there. So this is a case study. This person had a 59% DTI with 640 FICO scores. He was rejected by 3 other lenders because they never had done this type of product before. So we run the AUS, got the appraisal waiver, and fast-tracked it. So this is one of the examples that I have that I ran the DU on the March 6th. This person had a DTI at 58%, housing payment at 42. So this was a perfect FHA case file. But instead of sending it to FHA, I sold it rated at 6%, and I had a PIW on it. So I wanted to take out that 0.625 add-ons, LLPA add-ons, right? So I ran another AUS based on 60% LTV by upping the appraisal value from $600,000 to $686,000. By increasing the appraisal value, I was able to get the approved eligible at 58% DTI. DTI still is the same. However, the PIW eligibility went away. So which one will I choose? This one over that? And I'll show you my findings. If you go to Zillow and Redfin, the adjacent value at this neighborhood is $552,000. And I used a $600,000 as a value, estimated value, and I got the PIW, right? Don't be swayed by these Zillow, Redfin, or Realtor.com database. We don't have to do it. Because we have the system, we don't have to rely on these, incorrect information. And second case study, this person has a silent second with a KLHFA down payment assistance program. So this person wanted to pay off their Dream for All or KLHFA regular product. We were not able to do so because of the combining first and second is defined as a cash out refinance, not a rate and term. And KLHFA was not allowing us to subordinate the lien. So we were not able to proceed. So when we talk about the Refi Possible for Freddie Mac, so you need to know and memorize this. This is a one-time use product. And we cannot use this over and over again. If this was used once already before, we cannot reuse again. That's the unfortunate part of the Freddie Mac owned mortgages. So have the conversation with the borrower, run the AUS. There must be a case file that the AUS doesn't run. But don't be afraid. If it doesn't run, that means they already have applied and funded this product before. Okay? So it just means that they exhausted their eligibility, so they cannot apply anymore. Within the 2020 to 2023-ish, when the rates were low, most of the homeowners had this opportunity to get this. So that's why we want to approach these homeowners who got their homeownership back in 2023 and above. Okay? That's the intentional approach that I want everyone to take to minimize any losing time in the midst of nowhere. So let's put these programs side by side and compare. So Fannie for RefiNow, Freddie Mac for Refi Possible. Both require 100% AMI or below. DTI allow up to 65%. Credit score is, there's no requirement on the agency level, but some lenders may require 620 like UWM. And payment history is must be proven on the credit report. No late payment histories, at least for 6 months, and only one late payment allowed within 12 months. Rate reduction, more than 0.5% rate drop with payment decrease for both PI, and appraisal credit is $500 pass through if the appraisal report is required. If we have a PIW, we don't need to even mention about it. No cash out, only limited cash out is allowable, but only up to $250. And property type is only for the one unit primary residence for both Fannie Freddie. And subordination allows only for specific liens, but just consider that it's not going to allow. We cannot pay it off. And it was only available for the one-time use. And pretty much Fannie owned properties, we can reuse them, but Freddie Mac owned mortgages, we cannot reuse them. So this is the action plan. You have a client, pull the credit, search the property address, and then when you have OK by Fannie Freddie, then you run AUS. and confirm ownership. And then pull the AMI data and double check their income limit. And once these things are passed, then third, we look into the credit report and check the payment history. When there's no payment late histories on the report, then we tell them, should we lock or not? This final loan amount can be changed throughout the change of circumstances, but submitting the loans, running the AUS takes the most time. So I want you to find out and determine whether if it's Refi Possible advice on the one-time use restriction, and document the conversation so the client understands the reasons why they cannot get this loan. Run this checklist and every file every single time. And by the time you memorize it, you'll be able to say yes or no over the counter within 30 minutes. So all the purchase loans that we funded in 2022 and 2023, the ones in 7s and 8s will be our target points. They are watching rates and wanting to move down the rates. They think they're stuck, right? They assume that they can't refinance because their credit is messed up or isn't perfect or debt is too high. They're wrong. Let's prove them that they're wrong. Let's go back to our CRM, ERP, and pull every client who closed within the mid-2022 to late 2023, run their address through GSE lookup, and check their income, and get it done, right? This is working pipeline strategy that you can all experience. Any questions about this product? Nobody?